Fall asleep on this session because this is a very important one. Not that the first one wasn't. My name is Phyllis Wellborn. I'm one of the employee benefits specialists here at headquarters. And thank you for participating and supporting our Financial Literacy Month. I'd like to introduce Mr. Stuart Kaplan from the Thrift Savings Board for the second presentation, pre-separation seminar. Mr. Kaplan.
Okay, well, good afternoon, everybody. Glad to see everybody here. So a little bit a few more people than we had this morning, but this session, as you can see, and I think the reason that you're here is because you're probably getting close to actually separating or retiring, and you want to know what your options are to be able to take money out of the TSP and learn some of the things around the issue of getting ready for that date. So hopefully I'm going to make this useful for you. Like Phyllis said, my name is Stuart Kaplan. I'm from the Federal Retirement Thrift Investment Board. It's kind of written in small print at the bottom of the slide. So we're located over there on First and K, kind of near Union Station. And we'll just get rolling right along here. So I have a disclaimer. Basically, especially in this group, I think it's important to just kind of put it out there that this isn't meant to be financial advice. This is really meant to be education about the thrift savings plan and a lot of the rules, and that's really a lot of what this briefing is. It's a lot of rules. There isn't really anything much in here that I think you can misconstrue as financial advice anyway. But so that being said, what we're going to talk about is getting prepared for retirement. I want to spend just a little bit of time, and maybe for some of you here this morning, a little bit at the beginning here might be repetitive because I want to try to, again, put the TSP into perspective with all of your income in retirement. So we're going to take a look at that briefly, and then we're going to spend just a little bit of our time here in the beginning talking about things you can do while you're still working to make sure you get the most value out of the TSP while you can contribute to it. Because as you know, I'm sure you know that once you retire, you can't contribute to the TSP anymore. You can't contribute to the TSP from your retirement pay or from any other source. It's got to be from your salary. So we're going to talk about what the options are. A big part of, I'm sure the reason you're here is because you are interested in learning more about the changes that have been made or that will take place in September when the new withdrawal options actually go into effect. So I'm going to spend the bulk of our time talking about those and the ways you can take the money out. We'll talk about the life annuity options. We'll talk about taking the money out pro rata versus coming out of individual buckets, that is the traditional versus Roth buckets and so forth. And we'll also talk about some other considerations to include the taxes. So I know tax is not the most exciting thing, but there are some things that are important to know about when it comes to taking your money out of the TSP so you don't make some mistakes, because you can make some mistakes by making some assumptions, and then it turns out it can be a very costly mistake. We'll talk about death benefits. We talked about that this morning a little bit, but maybe I'll just go into a little bit more here. I think we kind of started to run out of time in the last session, but we'll talk about that. So basically, what we're talking about this morning, and I just want to reiterate some things about your retirement. So when you go into retirement, I think you already know that for most of you, I would expect that your thrift savings plan is going to be the biggest, strongest, most important leg of this three-legged stool. And but that's not to discount the Social Security and the pension, because the pensions have a built-in protection for inflation, and of course Social Security does too. Your TSP account does not. So we're not going to get into sort of a drawdown strategy in this session. So we're just talking about what the retirement options are. But one of the things that's going to be on your plate of things to do as you get ready for retirement is more than just, look at the list of the ways you can take the money out. You got to look out how much money you can take out. And so that's a whole nother problem that involves looking at inflation, because you're going to have to build in some kind of protection for your TSP withdrawals based on inflation. And there are so many other variables when it comes to a drawdown strategy. So that's not part of this session, but I would highly encourage you. There's tons of resources out there on the 4% rule There's lots of information about spending patterns in retirement, how your typical retiree spends a lot building up to retirement, and then in retirement the first year, 2, 3, and then their spending starts to taper off, and then later on it starts to pick up again. Usually, these studies look at broad swaths of the U.S. population, and they're looking at health care costs going up, and then long-term care costs coming in toward the end of one's retirement. But there's lots of spending shocks. There's lots of things that can happen with the market depending on how you're allocated. So it's really extremely critical to understand the bigger picture of what this problem is going to involve as you go into retirement, because you may have spent all these years building up this nice little nest egg, and you think everything's going great, and then you go into retirement, and it just happens that it's timed perfectly with a market correction, and there you are, sitting in the C and the S funds and losing, day after day, just more and more of your balance, and now you're no longer contributing, so you're not able to dollar cost average. You're dollar cost averaging the reverse because the share prices are going down, and you're having to take a larger and larger percentage of your balance to sustain your income needs. So all these things are really extremely important aspects of analyzing where you are in retirement. But again, what we're going to focus on today is just building up to that point and what your options are. So just really more of a fact-based sort of session. So I hope it's sort of a motivator for you to do a good job of this and really think it through so that you don't have to add that fourth leg to the stool, and work in retirement unless that's something you really want to do, and your retirement plans include that. But the basic problem is you're going to look at what your income is expected to be from all the sources, whether it's beyond the Social Security and the pension, other sources probably as well, your spouse's pension and their savings, and maybe a real estate, maybe you got IRAs, lots of things out there. You put that all together and try to figure out how much money are you going to need. And so from that, you're going to be able to see what is your TSP savings goal. Now, it's just an approximation based on a lot of factors that you don't know exactly. But that's basically what you're trying to do. So as you're building up to that goal, there are some things you may find useful to be able to kind of get as much money in that plan as you possibly can before you retire. So as you know, I'm sure, that the annual limit is $19,000 for 2019. It may go up in 2020. We'll find out toward the end of October when the IRS releases that information, and the TSP will publish it on the website, the tsp.gov website. But for your contributions, whether they're traditional or they're Roth, they're limited to $19,000 this calendar year. And this calendar year, of course, is January 1st to December 31st. It's not based on the GSA pay calendar. That kind of makes things a little bit confusing sometimes. But it doesn't count the agency contributions. So don't worry about meeting the limit because you got matching funds and whatnot. So it's just $19,000, whatever the tax character is. But if you are over 50, or if you turn 50 in this current calendar year, you can make what's called catch-up contributions. So I think you already know, but just maybe some review for a lot of you, that this isn't just increasing the amount of your regular contributions. On your EPP website, there's a separate link that's labeled catch-up contributions. And I'm not familiar with EPP. We use something different at FRTIB. But whatever it is, it's going to be a separate link and for catch-up contributions. And there is where you can add an additional up to $6,000. So it has to be a whole dollar amount, not a percentage of your pay like you can do with your regular catch-up contributions. And those contributions are not matched. So if you're a FERS employee, you do not want to do catch-up contributions unless you're on a glide path to get you to the point where you're hitting that $19,000 limit with your very last paycheck. And of course, we talked about this morning, I think hopefully you know that if you contribute less than 5% of your gross pay at any given pay period, you're missing out on some matching money. So you always want to be at least 5% each and every pay period. So therefore, with the $19,000, if you're maxing out, make sure you extend that all the way into the very last paycheck of the year. Now, you don't have to. I'm just saying maybe that's sort of following along financial advice, so to speak, but just basically just to make sure you get all the free matching money that's out there for you. Now, the catch-up contributions, okay, go ahead, yeah.
If you have a question, could you wait and let me hand the mic to you? Because we're live streaming this, so the folks out in the field can hear the question.
Sorry, Matt, your time. What I was going to say is, it's important for people on EPP, on Catchup, to reset that every year. You must do that every year. The other one, it rolls over, but the Catchup does not, so that is important to do.
Yeah, that's right. That's the way it is, no matter what system you use, because you can usually tell the people that don't know that, because around like mid to late January, people are walking around complaining they didn't get a pay raise, except for those few older people like me. We're walking around saying, "Oh, I got a pretty good little raise," and it's just because your catch-up contributions stop. So, if it is that we're at the very end of April, if you're still thinking you got a nice little raise this year, not counting like the little bump you had last week, but go in there and check, because he's right. The catch-up contributions, for some reason, all systems, they set it up so that they end at the end of the calendar year, and you got to go back in there and redo them. Now, the catch-up contributions, of course, you want to do those simultaneously along with the regular contributions for the reason that we just said, but you can, because they're not matched, if you wanted to, you could front load those catch-up contributions, and sometimes people do that. Now it's $6,000 is the limit for this year, but you may not want to try to put that all in one paycheck. If you can put that all in one paycheck, but you may spread it out over several paychecks or a couple of months or 3 months or so, but you can do that. Or you could wait till the end of the year, because you want to check to see what your financial situation looks like, and you want to just check to make sure you got enough to be able to put that additional amount in there. So it's up to you, but the most you can put into the TSP this calendar year, if you're over 50, is $19,000 plus $6,000. The other thing I was just thinking about, like you mentioned about check the catch-up, at the end of the year because it doesn't continue, is that a lot of people get tripped up by the fact that now I don't know your system, but in my system and in other systems I've seen, it asks you have to fill out how much you want to contribute each pay period. And you might put in there, I don't know, $500 or something like that. But if you're thinking, okay, $6,000, I want to max it out, you put in $6,000. I've seen numerous people who have told me their story about getting a paycheck that was zero, because they took everything, and they didn't even enough, thought they took $6,000 in one paycheck. It was just $3,000 out of this paycheck, and then $3,000 well, maybe not even that much. But so be careful with that. Now, the green box here just has to do, or is relevant for those of you that are not going to be retiring, and you're going to be going to work in the private sector someplace. So you'll retire, maybe get a FERS pension, but you're going to start working over with Boeing or SAIC or one of these places over here. And they have a 401k, which you can contribute to, and they have matching on that. But realize this $19,000 limit applies per calendar year, not per employer. So you do $19,000 plus $6,000 to the TSP, and you get it all in there before, I don't know, let's say August. I mean, you really do a good job, and you go to work for SAIC or some one of these places, and they have a 401k with matching. Well, you can't contribute to it, not until January of the following year, because you're already maxed out. Now, actually, in truth, you could, because they wouldn't know about the TSP, and if you didn't tell them, and nobody would know the difference, but what would happen is you'd end up over-contributing, and you have to get a refund of all those contributions that you made to get you down to the limit. You could take them out of the TSP, you could take them out of the SAIC, but it's just a hassle that you don't want to have to deal with. It wouldn't make sense. So the asterisk up here, and this may apply to this group. So I think this is actually something that might be relevant. 457B plans are like 401ks, like the TSP, in that they are defined contribution plans, so you put their money into the plan, you direct how you invest, but the $19,000 limit that applies to those plans is, in the IRS rules, separate from all other plans. So, that being said, these are state or local government type plans. And so the reason I say it might be relevant for you because a lot of law enforcement agencies have 457Bs. So if that's your plan, you might want to take a look at where it is you plan to go to work. If they have a 457B plan, know that that $19,000 limit is separate and apart from the TSP's $19,000 limit. It's weird, I know, I don't understand exactly why, I just know that that's the fact. Universities, state universities, same thing. It's a separate $19,000 limit. So you have an opportunity to really put a lot into your retirement savings over the course of that year that you change jobs. And then the blue box, this is again part of the planning stages. So with this in mind that you can only contribute $19,000 in a calendar year, you might not be retiring on December 31st. Retiring on December 31st brings with it some various issues, and you probably attend classes on, and maybe Phyllis can kind of brief you on best time to retire and so forth. But in any event, you may not have a full 12 months of employment with the DEA, but you still want to max out, and you can do that. It just takes some planning. You just have to increase the amount of your contributions. And of course, you're going to miss out on some matching money because you're missing out on some contributions for that year, but still you can do it. I mean, it may not be worth it to get all that, additional matching to work to the full end of the calendar year. Maybe you want to retire in September, August, July, something like that. But if it's not like this coming July or September, you might put a little bit of money aside so that when the year comes, you're going to separate. You've got enough for your living expenses, plus you can really double up on those TSP contributions and get that money in the TSP plus the matching, if that's what you want to do. So that's all I had to say about trying to max out your participation in the plan, because remember, like I said, once you retire, so a lot of people mistakenly think, well, I'll just put some of my retirement pay into my TSP account. Or they think, well, I'll just, sell my boat, and when I going to sell your boat, that's a bad example. I'm going to, I don't know what, I'm going to sell some, your wife's car, right, because, what do you care about your wife's car, So you're going to sell real estate or something, and I'm going to just take that chunk of money, I'm going to put it into my TSP there at the end and really bump up my balance. And so just want to emphasize, you can't do that. All the contributions coming into your TSP account got to come from your pay. But you can transfer money from other retirement plans into your TSP account, which may be a very good idea. So I think I'm going to talk about that a little bit later here. So actually, I think I pretty much talked about all the things with the catch-up contributions before we got to that slide. Now, this has to do with separating and still having an outstanding loan with the TSP. So as you know, you can take a loan out of your TSP account while you're working, and you pay it back through payroll deduction. But it has become very popular among pre-retirees to take a big loan out of the TSP, to take out the max amount that you can borrow at the very end of your career so that you go into retirement with an outstanding loan balance. So why would somebody do that? So basically, it has to do with the fact that the current withdrawal options are very limited. So if you take out a loan prior to retiring, and then you don't pay the loan back, which is your choice because it's your money, then that outstanding balance becomes a distribution. So in effect, a withdrawal. And then that means that one partial post-service withdrawal option that you have is still there. And you got another option to take money out before you get to the point where you have to fill out this full withdrawal paperwork. So I'm not going to spend a whole lot of time talking about the old stuff because it's going away. And for all of you, no matter when you retire, you'll be under the new rules. Even if you retire before September, September comes along, it wipes the slate clean, and everybody, even those people that have been in retirement, for a long time, they'll be under the new rules. But this is how this works, because you still may have an outstanding loan when you separate. So basically, when you separate, you're not going to get your final paycheck for about another month. So depending on your agency's payroll. But there's a lot that they have to calculate to go into your final paycheck. So it's when you get that final paycheck that your agency's payroll or finance office sends the TSP an electronic transmission that lets us know that you've separated. And at that point, we turn on the option for you to be able to make post-service withdrawals. If the participant or the employee has an outstanding loan, instead of us turning on the option to be able to make post-service withdrawals, we freeze that, because you can't make post-service withdrawals until you satisfy that loan or it's declared a taxable distribution. Anyway, it's over and done with. So we're going to generate a letter that we'll send to you. It's in a little package with a form, and the letter is going to tell you that you've separated, you have an outstanding loan, the balance is X, and the daily interest charge is X, because we take the annual interest charge on that loan, divide by 365, and that's the interest charge on a daily basis given the amount of your balance. So we tell you have either 90 days to pay it off, and then it all goes back into your account, the loan's paid off, and you're done with it. Then you can start making withdrawals. Or you could choose not to pay it off. In fact, we'll send you a form you can return to us at any time within that 90-day period where you tell us you're not going to pay the loan off, and we just declare that outstanding balance a distribution. So we'll issue a 1099-R. So that 1099-R is sort of like your W-2, which you'll just use when you do your taxes. After the end of the year, you'll add that amount of that taxable distribution to your ordinary income as part of figuring out your taxable base. So you can pay it off early. You can wait till 90 days to pay it off or not pay it off. But whatever is outstanding at 90 days, then it's automatically declared a taxable distribution. So I used to go into lots of discussion about this. However, I think that's probably not as big of a deal now, because you've got all these withdrawal options, and that seemed to be mainly the reason people were doing the loan at separation. But I'll just say this: if you do find yourself in that situation, think ahead, plan ahead as to when you're going to let that loan be taxed out, if that's your plan. Because if it's a large amount and it's taxed out in the same calendar year that you received your income from the DEA, well, then that's going to, change your tax story a little bit. That's going to increase the amount of taxes you're going to owe. You're going to pay at your marginal rate a bigger percentage of your income. So if you want to do that, you may think maybe time it for the next calendar year, but it's up to you. Questions with outstanding loans? We'll move on. All right. So the next thing I want to talk about is your quarterly statement. Now, you may be someone who rarely, if ever, looks at your TSP account balance. Maybe you got life cycle funds, or you got some allocation, and you sort of let it, go on autopilot, and you don't stress out over it. That's a whole group of people that subscribe to that idea. Don't really stress out over it. Or you may be someone that looks at your account every other day. And in any event, however you want to do that, that's up to you, and it works for you, I'm assuming. But don't forget, when you're looking at your balance and trying to calculate your percentage of growth and all those fun kind of things, look at your quarterly statement and take a look at some basic things like your address. Is your address correct? Chances are it is correct. However, it's possible it might not be, because if you've moved recently and it was maybe in the local area and it wasn't like a move that required you to go and update your address everywhere, it could be that we have an old address on file. So you can update your address. So I'm assuming here you would do it through EPP, but that's important as you go into retirement. So make sure that there's no hiccups when you start taking withdrawals or we send you correspondence. We want to make sure that it gets to you. And another thing to look at is over on the right-hand side, you've got your participant information. So I would say that it's really rare that you would have a mistake over here, but it doesn't hurt to just double check it. Make sure your date of birth is right, because that's extremely important for all kinds of reasons. And make sure that your TSP SCD date is correct, or at least it reflects at least 3 years of federal service. It should be all right. And I'm sure here, Phyllis and the folks in her section can take care of that, help you with that. because that's the vesting, affects the vesting for the agency automatic 1% and the earnings. So if there's some kind of error, which, there's all kinds of reasons errors can kind of creep into the system, but if there's an error, you could separate, and even though you might have 30 years of service, if your TSP SCD date shows less than 3 years, then all your agency automatic 1% and the earnings would be forfeited back to the TSP. So once you catch the error, even if it's later on, no matter when it is, there's no deadline on this, the error will be corrected, but it's just a hassle that you don't want to have to deal with. So it's better to check that in advance. And of course, you might be looking at your quarterly statement and looking at your personal rate of return and how you're allocated and so forth. But just one more thing on the address change. It's better to change your address while you're still working so that you don't have any hiccups going into retirement. But after you retire, you're going to be able to change your address easily. There's a whole different process once you've separated that we can't do while you're still working. But the process for changing your address is as simple as calling the thrift line and then changing it over the phone once you've separated, but not while you're working. And you can't do that while you're working. So now I'm going to kind of get into a little bit more about some things that I think are relative to the decisions you make around keeping your money in the TSP, as opposed to now we're just trying to get more money into it. One of the primary benefits among many things that the TSP has is the low investment costs. So this chart is taken from a similar chart that you see if you get, like you got your annual statement, you get the highlights in there. If you get a quarterly statement mailed to you, you get the highlights in there. It's similar to those charts. But it shows a breakdown of the expense, administrative expense, that is, per fund. So there's 10 funds, 5 core funds and the 5 life cycle funds. So there's the gross cost and then the net cost. There's a couple of things that we do to bring the cost down, but the most important of which is the forfeiture of the agency automatic 1% contributions and their earnings. So that's what I said, if you're employed for less than 3 years and you leave, and after 30 days of being separated, that's just automatically forfeited back to the TSP, and we use that to bring down the administrative costs. So the bottom line there is we've got the net costs, and these are administrative costs, not the expenses associated with the investments. So it brings us down to about 4 basis points on average. But the other expenses are basically what we pay BlackRock, the financial company, to manage the C, S, F, and I funds. But the cost we pay them is really low compared to the value that we get from them, because they do a number of things for us, including pricing the shares, which includes adding in dividend income, interest income, and income from securities lending. So it really makes for a big difference. Now you can look at the expenses of mutual funds through IRAs, and there are a few more IRAs out there, I should say mutual funds, that you would include in your IRAs that have like 0 expense ratio. So this is really extremely important, but it's not the only thing, because when we invest on a passive basis, it's not just with the TSP, it's not just the capital gains and losses that determine the percentages of your returns. It's, again, like I said, the dividend income and interest income, especially for the F fund, and also the securities lending income. And the securities lending income for the TSP, like we talked about this morning, it's something you probably don't know a whole lot about, because I don't have a whole lot on the website about that, but it makes a tremendous amount of difference. Because I'm telling you, the TSP has about $600 billion in assets, and there isn't any plan sponsor that comes close to that. I mean, we're miles and miles apart in terms of the size of the plan and the amount that we do for securities lending, and then the benefit that we get, the profit that we get based on that we can invest the collateral in the G fund at maybe 2.5%, but the amount that of income that you get from that improves the returns of the funds. I think it mentions it up here on this slide. So be thoughtful about decisions about taking money out of the plan. But I just want to say that this is not something to be just sort of, okay, well, it's half a dozen, 1/6 of the other. So just to kind of compare apples to apples, you get the 4 basis points of cost in the TSP, so it's 40 cents per $1,000 account balance per year. And then you have the average 401k plan, which we have about, based on this study, about 41 basis points. So 10 cents per $1,000 accounts balance per year. So comparing the two.
Can I ask you to go back
Sure.
to the prior slide with
This one?
the TSP? Yeah. Is there a reason why there's no 2050 life cycle on that?
Because I made a mistake and I wrote 2060 instead of 2050.
So that should be 50, we're the 60.
So how many times have I briefed this and nobody's brought that up? Hey, that was pretty good. I had to pay you for that. Who said? Was that you?
Put your TSP fund.
Yeah. So I also work part-time as an accountant, and I manage your. No, I'm just kidding. No, they wouldn't let me do that. So that's good. I'm glad you caught that. I got to fix that. Yeah, good. Okay, so now the cost really makes a difference. So I got two charts up here. I got one like short-term basis, like 10 years, and one the 30-year, a little bit longer term. But basically what I'm doing is I'm saying if I had a $10,000 balance in my account and I didn't add to it or take away from it, and I left it there over 10 years in the TSP versus in an average 401k, what would the balance difference be? So it turns out on that scenario it would be about $613. If it was $200,000 over 30 years, the difference would be about $113,000. So it does make a big difference in terms of just looking at the costs. And I'm assuming a 6% average annual rate of return, like I should have said that at the bottom of the slide. All right, so we talked about moving money from other plans into the TSP. You can do this at any time. You can do it now, you can do it after you retire, it doesn't matter. It may be that you leave the DEA and you go to work for another company and you have a 401k, and when you leave that employer, you can move that money into the TSP. Or maybe you got employer plan money out there right now that you can move into the TSP. Maybe you got a traditional IRA, you can move that into the TSP. But all the plans that are eligible to be moved into the TSP through a direct transfer are in this orange box. So it includes Roth money in Roth employer plans, but not Roth IRAs. The IRS doesn't allow Roth IRAs to be moved into employer plans. Yeah.
How long does it take for that to take effect when you transfer it, when you roll something over? Like just a month, a couple of weeks before it's in your TSP then?
Yeah, the question is how long does it take? So that depends largely on the plan sponsor that, when they process the paperwork, because sometimes they drag their feet, sometimes I've seen this happen, and so my wife has actually done this a couple of times, and we had the experience, personally with her account. And on our end, it doesn't take, that's not the problem. It's usually the other plan. So I'll go through the process here in just a minute, but this direct transfer is a way to move the money directly from that plan, that's what it says, to the TSP. So it doesn't involve the money touching your hands. So there's no taxable event. So if you just want to move the money, this is what you want to do. You want to mess with doing an indirect rollover. Now, traditional IRAs, you can move that money. The pre-tax part of if you have after-tax money in a traditional IRA, you can't move that. But so the second method is fraught with pitfalls because they're both withdrawals. The first one is a withdrawal, but on the withdrawal form, you just mark transfer and it sends to the TSP. The second one is a withdrawal that comes to you. Now it comes to your bank account as an EFT or a check to your mailbox, and it has to follow the IRS rules, and the IRS rule that is the biggest issue here usually is the withholding that's mandatory. Federal income tax withholding of 20%. You can't, waive that. Now, you can have more withheld if you wanted to, but you have to at least 20% withheld, yes.
So that's a TSP 60R, right, that form you use?
Well, the TSP 60R is not a withdrawal form. The TSP 60...
Yeah, the transfer.
Yeah, the TSP 60, in this case, so I was going to talk about, give me just a second, and I'll talk about what the forms do. Then we'll go through each one of those. But this method, the indirect rollover, is where they send you the money, but they can only send you 80% of the withdrawal that you take. The other 20% goes to the IRS, and the other 20% is taxable. So this is a taxable event because the money's touching your hands. If you happen to be under the age of 59 and a half, and you don't meet an exception based on your employment over here with this other plan sponsor, well, then you have early withdrawal penalty applied to that 20% as well. So the thing about the indirect rollover, this is specifically for people that want to get their hands on some of that money. So maybe you get the 20% withheld, you get the 80%, let's say it's $80,000, but you want to spend $40,000 of that on an RV, or you want to take a trip on a cruise, or you want to buy, put a roof on your house, remodel your kitchen, or whatever you want to do. So for those people, we expect that they would look at the tax issue, look at their budget, and if they needed to get help from somebody, it's not that difficult a problem that they can lay this out and figure out, what this is going to cost them. So it's their money, they can take a withdrawal, and then they can spend it however they want, and they put, what they don't spend into the TSP, and then roll that portion over. So that's why this indirect rollover process exists. If you're just transferring the money from one plan to the other without trying to pay taxes or spend the money or touch it or do anything, then you want to do the top one up there. So unfortunately, the reality is a lot of people don't read instructions. Like I can attest to that, but if it's putting together like a bookcase from IKEA, that's one thing. But when you're talking about your retirement money, that's where unfortunately you got to sit down and read and understand it, or call the thrift line and ask them. It's not that difficult. And in our summary booklet on page 10, because I got the reference down there, it goes through it as well. But so here's what I'm going to talk about the forms. What's involved here is just really two forms. The withdrawal form of this plan, not TSP's withdrawal form. It has nothing to do with this plan, but you're going to get their withdrawal form. The first case, you can just mark transfer, TSP's address, etc. Down here, you can do a withdrawal form. Yeah, I'm withdrawing the money. It's a lump sum withdrawal, and then when I get it, it's a rollover. The TSP 60 is for tax-deferred money that you have in another plan that you're moving. The 60R is only in the case of the transfer, because that's the only case where you can move Roth money, but that's Roth money in a 401k. So what you do is you send them the withdrawal form and the TSP 60 and or TSP 60R, and that form's purpose is only so that that plan, an authorized person can sign to certify that this money that's in this plan that you're moving the money out of is an eligible employer-based retirement plan, or it's a traditional IRA. That's the purpose of the 60 or the 60R, because it's not a withdrawal form per se. It's just because we can't put money into the TSP that's you sold some real estate and now you get some or some money out of your savings, or it's from an annuity that's not one of these types of plans. Because there's plans out there where you have sort of a pension, a defined benefit plan. Can you move that money? No, but you might have to look at the actual rules there. Yes, sir.
What is the difference between a TSP 60 and a TSP 60R?
60 is only for tax-deferred money, and the 60R is for Roth money. So you got like a Roth bucket in your 401k that you're moving. Yes, sir.
Two quick questions.
Sure.
On the first one that you're talking about, if to me, kind of the benefit would be if you were under the age of 59 and a half, had money in a traditional IRA, move that into the TSP, and you're not 59 and a half, again, you're 55, 56, suddenly you can start receiving that money, right, without a penalty.
Yeah.
Yeah, I mean, that's kind of the benefit.
Yeah, that's one of the things. Yeah, because for more so for you, a lot of you are law enforcement. You're public safety employees. You're that special code of FERS, and if you separately retire in the year you turn 50 or older, there's no early withdrawal penalty.
Right.
It's law enforcement.
Beautiful.
So you could transfer. You had an employer out there that, let's say, for example, you weren't law enforcement. You didn't have that rule, because there's in the private sector it applies too. for certain occupations, law enforcement being one of them. But let's say it wasn't anything to do with law enforcement. Let's say it's your, well, no, that's a good example. But yeah, you're right. You can just transfer to the TSP, and then you bring down your early withdrawal penalty to 50 instead of 59 and a half.
Right. All right, the second part of that question is, hypothetically, your wife has an IRA, and can you move, if long as she was willing, could you move that money into the TSP, your spouse?
No.
Oh.
No. Well, if it's received as a death benefit, then the rules change a little bit. We're not going there yet. We'll talk about death benefits later, but she may be okay with it, but still the law doesn't allow you to do it. So, okay.
I've got
Yes,
one
sir.
question.
Okay.
If you're retired, okay, and you're still drawing for TSP, you work for X, Y, and Z corporation, and then you leave them, are we allowed to move the 401k from that corporation, being retired, into our TSP account?
Yes, absolutely, yes. It's probably a very good idea. Yeah, anything else? Okay, so we're going to move on here. All right, so this has to do with combining your Uniform Services TSP account with your Federal Civilian TSP account. So you don't have to do this, but the reason you might want to do it because it might make things simpler, especially after you retire. There wouldn't be any benefit really to having the two separate accounts, but while you're working, a benefit of having the two separate accounts might be that you can take withdrawals from the account that's associated with the employment that you've separated from. Even though you might have an early withdrawal penalty, it just gives you that option if you really need to access that money. You got some kind of financial emergency, you got nowhere else to go. You hate to dip into your Uniform Services TSP account because you got the penalty, but you got to prioritize. And if that's something, a viable option for you, you got the ability to do that. So if you have tax exempt money in your Uniform Services TSP account, that's kind of a special rule that the IRS allows tax exempt money to be in that account, but they don't have the same rule that's applicable to your civilian TSP account, because that's just they set the rule. So you can transfer everything but that tax exempt money. So any questions with the combining accounts from your Uniform Services side? All right. So now, current rules, you can do a one-time age-based in-service withdrawal, which precludes you from the ability to do a post-service partial withdrawal. Again, that's all going away in September. September, we wipe the slate clean. Whatever you've done in the past, it doesn't matter. But here's the rules currently. You can take out a withdrawal, which you can transfer into an IRA or into another employer plan if you wanted to. It's kind of like we saw the previous chart, but just go in the opposite direction, out of the TSP into another plan. And it has to be at least $1,000. You can take out your entire vested balance if you want, but you still will have your TSP account because you're still an active employee. Or you can have all of it come to you, and whatever portion of that withdrawal you have come to you, like as a check to your mailbox type of thing, it's going to be that eligible rollover distribution rule of 20% mandatory withholding applies. You can't get around that. You can increase the withholding, but you can't waive that. So that's currently the changes are going to be made to the income options, and I'll go through the age-based in-service withdrawal, which now is much more flexible. And so here's sort of before we move on with actual rules, we could talk for a long time around the issue of decisions to keep your money in the TSP versus pulling it out. But there's a lot of things to consider besides all the misconception type things that financial product salespeople are going to tell you. You can keep your money in the TSP, like as long as you have a balance of $200 or more. When you separate, you can keep your balance in your TSP for life. But of course, the IRS has rules that you have to start taking these required minimum distributions at age 70 and a half assuming you've separated. If you're going to work past age 70 and a half, RMD rules don't apply until the year that you separate. So I don't know if anybody's planning to work past age 70 in this group. I don't think for a lot of you it's not even an option. But RMD rules will apply only after you've separated. So you can roll in balances from other plans at any time. You can continue to access the TSP website and do interfund transfers just like you do now. If you want to adjust and change your balance allocations among the funds, you can use the life cycle funds, or if that's what you want to do. But you can continue to do that and enjoy the low costs of investing in the TSP and the great choices that you have with the 5 core funds. And as long as you have a balance in your TSP account, you can keep your money in there. And you've got, with the new withdrawal rules, you've got a lot of flexibility to make adjustments as your income needs change as you get older and further along in retirement. So this is a slide with an overview of the TSP withdrawal options. At the bottom, there's a link to the TSP's Q&A fact sheet for the withdrawal options, which it's kind of brief, but it's to the point. We do have a withdrawal booklet, but the one that includes the new withdrawal options isn't on the website just yet. It should be. I'm not sure exactly when it's going to be published on the new website, but the one that's out there now, it has a lot of information that's still valid, especially when it comes to annuities, but it's not going to be correct when we change over to the new rules in September. But I'm going to go through them in just one by one. Here's the current rules. Age-based in-service withdrawals we talked about. If you are under the age of 59 and a half and you have to access your money in your account, you can do a hardship withdrawal if you certify that you have a hardship. And basically, you're just certifying by checking a block saying you have a hardship. And if you do that kind of withdrawal, you have to take out at least $1,000. It has to be from your own contributions and earnings, but you're not allowed to make contributions for 6 months following that kind of withdrawal. So that's a big drawback. And then the other way to access money in your account would be through loans you have to pay back. But once you separate, then you're limited to the one-time partial withdrawal that you can do, which can be a whole entire account balance. But do that one time. But again, you can only do that if you didn't do the age-based in-service withdrawal. After that, you want to access money in your TSP account, you have to fill out this full withdrawal form, which forces you into making a decision about a lump sum withdrawal right then and there. Do you want to, it says single payment. So do you need I don't need the money right away. Well, this is your only other choice to get a one lump sum payment, so you better take it now or not. So people would take that withdrawal, they might put it into an IRA or not. Annuity, life annuity. So you want to take a withdrawal, you want to start your monthly installment payments to start getting income on a regular basis. But when you fill out the full withdrawal form, you're forced into deciding whether you want the life annuity or not. So a life annuity is where you take a portion of your balance from your TSP account and you purchase a stream of income that's going to last, every month for the rest of your life. And you may be, 55 years old, and an annuity choice at that time for you, given your situation, may be a really bad idea. And you may live another 30 years in retirement. Age 85, you decide, now is the time I want an annuity. Well, it's too late. I mean, you only had that one choice back when you were 55. So there was a lot of issues that a lot of participants had, and so the TSP pushed harder than anybody to get Congress to change the rules, which fortunately they did. So that's what we're going to talk about next. In-service withdrawal rules, pretty much the same, except for age-based in-service withdrawal has no limit. You can do as many of those as you want, but, well, it does have a limit. You're limited to no more than 4 a year. And they can't be any more frequent than 30 days apart. So,
4 changes a year?
no, these are lump sum withdrawals. So you're still working, you're still employed past age 59 and a half, and you're taking withdrawals. So, but you can do, as long as you can do 4 a year. So if you worked age 65, how many is that? You can do 20 of them. But that you probably weren't going to want to do that. But The thing I should mention before I move on with this is, now for a lot of you, you're probably close enough to retirement that changing over to Roth contributions is not going to make a whole lot of difference. But younger folks that are, maybe, I don't know, maybe not the DEA, not the best example, I'm sure, but people who are intending to work past age 60 may benefit by making Roth contributions, so that when they take age-based in-service withdrawals past age 60, like they can here, with the new rules, they can take them from the Roth bucket first, which may make a whole lot of sense, because at that point your income may be at the highest level of your working years. So no financial hardship withdrawal changes. On the post-separation side, now you can start taking your installment payments at any time, but you can also do lump sum withdrawals, and there's no limit to those. Well, there's a limit, except, I shouldn't say there's no limit. You can't take them any more frequent than 30 days apart. So that's the limit. But other than that, if you're taking monthly payments, or you can even choose to take quarterly payments from your account, or annual payments if that's what you want to do, while you're doing that, you can also take lump sum withdrawals. And when you're taking these installment payments, you can set them based on dollar amount or life expectancy. But if you set them on dollar amount, you can make a change at any time, midway through the year, spring, fall, winter, whenever you want to make the change to the dollar amount. Increase it, decrease it. So you've got the flexibility there to do that. Now, I'm gonna go through the life expectancy versus dollar amount difference, and I'm going to talk about the life annuity, because there's a major change to the life annuity, in that you're going to be able to choose a life annuity at any point in your, after you separate. You don't have to, be forced into choosing, yes or no at one particular point. So keep in mind the pro rata deal is changing. So currently, you can only take withdrawals if you have both a traditional and a Roth balance. Pro rata means proportionally from both balances. So in my account, I have $90,000 of traditional money and I get $10,000 of Roth money. When I take a withdrawal, it's going to be 90% and 10%, no matter what. I don't have any choice to do anything different. I mean, there's some ways I can work around that, but basically I have to take pro rata withdrawals. So under the new rules, I can take my withdrawal pro rata just like I just explained if I wanted to. Otherwise, I can choose from which bucket I want them first to take the money. So in other words, let's say 90, 10, 90,000, 10,000. I want a $10,000 withdrawal, and I want it all to come out of my Roth bucket. So I take it all out of the Roth bucket, that depletes it, now it's down to zero, and then from then on I can take withdrawals out of the traditional bucket. Or I could say I want a withdrawal of $20,000, take it first out of the Roth bucket, so all $10,000 of the Roth money comes out plus $10,000 from the traditional money. What I can't do is I can't say I want a $10,000 withdrawal, $5,000 from traditional, $5,000 from Roth. I can't do that. Either pro rata, or I tell them from which bucket first to take the money. And so I talked about earlier installment payments, which can be monthly, quarterly, or annually. I can choose to have a dollar amount sent to me, which I can change at any time. However, we can't get around the IRS rules with regard to how withholding is handled and the transferability of the money. And the IRS rule hinges around this 10-year, I don't know, it's called the 10-year rule, but it's this 10-year calculation. So there are two main categories of withdrawals from retirement plans. One is eligible rollover distributions. So these are normally lump sum withdrawals or installment payments that are expected to last less than 10 years. So I'll explain that in just a second. But basically, what the rule is with eligible rollover distributions is that the money that comes to me, that comes into my bank account or my my mailbox, is assessed a 10% mandatory federal income tax withholding. So I can increase it, but I can't, make it less than 20%. So that goes to the IRS, and what I get is 80%. So that's just a withholding. It's not a tax per se, but it's a withholding. But the other side of it, eligible rollover distribution, is it allows me to roll the money over or transfer it. It's really a better way to explain it. So that when I get a withdrawal from my TSP account of $500, instead of having that $500 go to me, it goes to my IRA. So it could be I'm moving tax-deferred money to a traditional IRA, so no taxes are due, and it's not considered a contribution to that other plan. Or I could take my tax-deferred money and I could put it into my Roth IRA. So that's a transfer, but taxes are due because I'm converting the money from tax-deferred to after-tax or Roth. Or I could split out my distribution, so I get $1,000 withdrawn from my TSP account as an eligible rollover distribution. 50% of it comes to me, so that's $500. So that's gonna be less than 20%. So I guess you get $400. $100 goes to the IRS, but the other $500 that I transfer into my IRA could be traditional or a Roth IRA. So that's just transferred. It'll only be taxed if it goes from tax deferred to Roth. If the payment is expected to last more than 10 years, even though it's an installment payment, it would be considered a periodic payment. I should say it again, periodic payment. So a RMD is always a periodic payment. Payments based on life expectancy are always periodic payments. So periodic payments are not transferable, but they are they're still taxable, but you determine how much you want to have withheld. There's a default, and the default, if you don't fill out the part of that form, normally you're going to fill out the part of the form where you can say how much you want to have withheld, but if you don't fill that out, there's a default of they consider you to be married with 3 dependents, and then they tax you accordingly. But you can have 0% withheld in the beginning, you can have 20%, 10%, however you want to set that up. But with those kind of payments, with tax law, you've got to be careful that you don't under withhold, because then you could be in a situation at the end of the year where you owe too much in taxes, and you put yourself in a category that you're going to be penalized because you didn't pay estimated taxes on a quarterly basis. So you're going to be careful about, even though it's nice to think, okay, I can pay the taxes up front, have it withheld up front, or I can pay it on the back end. Yes, but only to a certain extent because of the rule with the estimated taxes. So here's how the 10-year rule works. If I had $100,000 in my account and I asked the TSP to send me $1,000 a month, we just do that simple calculation, 1,000 into 100,000 equals 100. 100 months, their monthly payments, we're assuming, 100 months is less than 120 months, which equals 10 years. So therefore, it's less than 10 years. So these kind of payments would be eligible rollover distributions. If I ask for $500, 500 goes into 1,000 200 times. Well, that's more than 10 years. It's 200 months, more than 10 years. So therefore, they'd be considered periodic payments. So we got fixed dollar amount. We got based on life expectancy. If the payments are based on life expectancy, we can't choose the amount. The amount is going to be calculated based on our age and our account balance. And I'm going to show you a slide here and a couple more slides. I'm going to go through the life annuity first, but I'll show you how those are calculated. So life expectancy payments can begin at any age, and we have to use 2 tables to determine the amount. And the tables are provided to us by the IRS. And the first one goes from any age up to age 69, and it has a factor built into the column next to the age. And I'll show you how we use that factor to calculate the amount of the payment. For age 70, we use a different table, and then there's a big kind of a jump in the difference in the factor. So from age 69 to age 70, even if we're doing life expectancy payments, at age 70, the amount is gonna jump. In fact, it's gonna drop down. But the reason for that is that RMDs begin at age 70. And so that table that begins at age 70 is built for RMDs. And they do different factors between the two tables. So I'll show you what those are in just a few more slides. So questions up to this point? We're going to talk about life annuities next. Yes, sir.
If I'm drawing funds, or excuse me, I'm setting my allocation to draw funds from my TSP, okay? Can I change that more than once a month? And if so, is there a fee to change it?
Yeah, so interfund transfers, you can make interfund transfers what we call unrestricted basis twice a month,
Okay.
twice a calendar month. And after that, you can still move your money as long as you're moving it from whatever funds into G,
Right,
only that one direction.
okay.
And there's no fee.
Now, the amount that you're receiving on a monthly basis, how often can you change that amount? Is that once a month too, or what?
Yeah, you could change that. As far as I know, you can change it any time. So you could change it, from 1 month to the next. You probably wouldn't
Right,
do
I
that,
don't, I
but
don't
you
see
could.
myself doing it, but there's gonna be a time when it is gonna be changed, so.
Yeah, and you got the ability to take those lump sum withdrawals at any time as well.
Right,
So that might help.
okay, thank you.
So let's, any more questions? I want to move next to the life annuities. This is something that has not been very popular because, like I said, we force people when they do the full withdrawal to make the choice at that time, and for a lot of folks, it just doesn't make any sense. But let's just kind of review what a life annuity is. What we're doing here is we're taking money out of our TSP account and using it to purchase a contract for a stream of monthly payments that are going to last the rest of our lives. And though that stream of monthly payments can be in one of three forms. One is for the rest of my life only. When I die, the payments stop. Or it can be for both my spouse and myself, so that the surviving spouse continues to get those payments for the rest of his or her life. And it doesn't matter if that surviving spouse is the original participant, that owns a TSP account or not. And then the other option is similar to that, and that's where the payments last through the life of the surviving person who is the other survivor. And this is somebody that has a financial interest in my continued life. So someone that depends on me for their income. They're not able to earn income of their own. So it might be, it would be something like a special needs kind of situation. So that's what that's for. So the benefit of a life annuity is it locks in a payment every month for the rest of your life. So no matter what happens, you can't, take all that money, supposedly all that money, and then give it away to some fraudster who convinces you to, some investment's really great and you have to do that. Because it's going to be there like your Social Security or annuity every month, until the very end of your life. So it eliminates the risk that you're going to run out of money. Because your TSP account, yes, it's possible, depending on the market and how you're invested and how you spend it down, all those kinds of things, that you can get to the point where you get your check and it's the last one, and you run out. No more TSP money. Now you got to figure out something else. With an annuity, it's never going to happen. The other thing with an annuity is it's a contract that says we're paying you X amount for the rest of your life. So if the market has a major correction like we did back in 2008, and then a couple of years it does okay, then has another major correction, it does not any of your worry. Because our annuity vendor, as TSP participants, is MetLife. They've locked into the contract and they're paying you X amount every month, month in and month out. You don't have to worry about that. Whatever the market does, you can just switch the channel and don't stress out over it, because you're getting that check for the rest of your life. So those are the things that reduce risk that are kind of on the positive side. On the negative side, you might think about, well, if I had my TSP account, I could manage it and I could move my money around. And assuming, now we're kind of, been, I don't know, what's the word I'm looking for? We've kind of been lulled into a sense of, how good the market can be, because the last since 2008, the market's been pretty good. I mean, we especially the TSP, we've done pretty well, historically, we compare. So we think this is going to continue. We don't have to really worry. We're not going to have any, we had this kind of scare at the end of 2018, but now we're all back to almost exactly where we were in September. So we think, not to worry, the market's going to be fine. We can manage our account. The G fund, we don't have we don't have to be in a money market fund like we do in another 401k. With a G fund, we got, pretty decent rates of return, 2%, 2.5%, 3% maybe. Well, who knows what's going to be in the future. So that helps us. So if we do a good job of managing our account, maybe we can take more from monthly payments from our TSP account and by how we invest, make our account last the rest of our lives, and by therefore have more money and still have last the rest of our lives. But the risk is on us, right? Because we can't control the market. Hopefully, things will be okay, but it's still a risk that we take. And plus, when I die, I should say, that money that's in my TSP account, it's going to, I'm going to SPCA, or I'm just having to go to, I don't know, whoever, wherever. The DEA Officers Memorial Fund or something like that, or a trust. I have it set up and it's paying out to my grandchildren so they can go to college. So I know that when I die, the rest of my money is going to a place where I want it to go. So that's one of the attractions to leaving money in a TSP. If you die with money, you bought an annuity, when you die, that's it. That's it. They fulfilled the contract. There's no more rest of the money. However, what you can do is you can protect yourself somewhat in that regard with an annuity, because you can set it up so that you get the cash refund feature. So when the cash refund feature is when you purchase the annuity, you're willing to take a little bit less of a monthly payment in exchange for the benefit of, if you die prior to receiving payments that are equal to what you originally paid for the annuity, then the difference is paid to your beneficiary, or beneficiaries will split it. So you live long enough to receive $90,000 worth of payments, but you had paid $100,000 for the annuity originally, so your beneficiary will get $10,000. Of course, it'll be taxable if it's tax-deferred money. But on the other hand, another option is you could purchase the 10-year certain feature. So 10-year certain means that the payments will last 10 years no matter what. If you live past 10 years, 20, 30, 40 years, whatever, and beyond, the payments will last the rest of your life. But if you die before the 10-year point, then the payments will continue to your beneficiary up to that 10-year point. So it's not a clear cut, absolutely this is better or that's better. It's just a risk, because you don't know how long you're going to live. I mean, it could be, you can take a good guess at it, but you just don't know. So it's a way to sort of reduce risk. Now, you can choose to get increasing payments or level payments. You might think, well, why would anybody choose level payments when they get increasing payments? It's because, of course, the increasing payments starts off at a low amount. And every year, the monthly payment amount goes up a little bit. It's about 3%. So you can look on that website right now, on the TSP.gov website, on the retirement income calculator, and you can plug in various scenarios and see exactly what you'd get if you had an annuity starting today. So the calculations that go into determining your monthly amount are your age, and if it's your spouse involved, it'd be your spouse's age, and the amount that you use to purchase the annuity, the type of annuity, the features that you add to it, and, this is the big thing, the annuity interest rate index that can change and usually changes every single month. And it sort of follows the G fund rate. Usually it's just a little bit above what the G fund rate is. But as you know, interest rates in the economy are pretty low, lowest they've been for this long in the history of this country, as far as I know. And so that calculation results in an annuity payment that's not as attractive as it was, like, say, 10 years ago, or even more than 10 years ago. And you're locked in. When you purchase an annuity, As interest rates in the economy go up, your annuity is not recalculated. It's set at today's rate, and it's that month, that same amount every month for the rest of your life. Okay, so maybe I've kind of dissuaded you from an annuity, or maybe, I don't know, persuaded you about it, but whether it's right for you depends on a lot of factors. That it's not just like a clear-cut kind of a thing. So there's many ways to look at the value of an annuity, especially the TSP life annuity, and especially considering that you can do this at any time. So you're not locked into doing this when you first retire and you make your choices. You can wait, and it could be, for many people, and there's just an infinite number of situations we can think of, but just one of many situations might be that somebody chooses to take amount of their TSP account and purchase an annuity when they're older, maybe in their mid-80s, because now they've sort of got a spending pattern and a budget that they're kind of locked into. And they've sort of already done the catamaran around the world deal and the whole rock climbing thing, and then they did all their whatever things that they were going to spend money on, but now they know how much they're going to need, and they just want to make sure the money lasts for the rest of their life. And maybe they have to balance their TSP account that they don't want to take the risk with. Maybe they can gift it to a charity, or who knows. But there's lots of ways to look at this. But being able to choose the annuity at any point really gives a person time to be able to think it through and see how it works along with their other options in the TSP. So I don't know. Questions on the TSP life annuity? Yes, ma'am.
The cash refund feature, is that new?
No, that's been around for a long time. I don't know when, but it's been, I think it's since we started having the annuities.
Okay, so I can get more information on the website that you have listed
Well,
on there.
yeah, so a website's good. In the withdrawal booklet, which that you can download from the website, which will soon be outdated, but the information about annuities for the most part is correct. From pages 8 through 11, it goes through all the features of the annuities in that booklet. And so, speaking about annuities, this gets to be a really confusing topic. The TSP annuity is what's called a single premium immediate annuity. So the premium is just like your $100,000, $200,000. You buy the annuity with that. That's the premium, and it begins the following month. So that's the immediate part. For I don't know how many of you have encountered people that want to get their hands on your TSP money, because you're a big target, and there's you have a lot of money that they'd like to get their hands in your pocket and get some of that as a commission. And the number one product that they want you to purchase, that's the most profitable thing to them, is annuities, but they're usually deferred annuities or indexed annuities. And there's a lot of really convincing sales pitches. So they're good at selling those products and convincing people, but be very careful, because you're locked in, and then you think they try to convince you that it's real flexible and everything, and then you want to get out of it, and you find out there's a big penalty. So, but the nice thing about the TSP annuity, like I said, is that there's no big hurry. You're not forced to make the decision now. You can make it later if you like to do that. So, all right. So required minimum distributions. I'm going to go through the chart here in just a minute. But these have to occur after you've separated and are age 70 and a half, and then every year thereafter. So when I say 70 and a half, it means if your 70th birthday is honored before June 30th, you're going to turn 70 and a half that year. So a distribution has to come out for that year. For that very first year, it doesn't necessarily have to come out in that calendar year. You got until April 1st of the following calendar year. However, in reality, it doesn't work like that, because well, it works. Here's how it works. If you don't fill out the paperwork to tell the TSP how much money you want to have come out of your account for your required minimum distribution, let me back up here. Let's just say, for example, that you're in retirement and you're not taking anything out of your TSP account. You're just letting it grow. And in the year you turn 70 and a half, you're supposed to take a withdrawal, but you don't send a form into the TSP, you don't contact the TSP, you don't do nothing. We contact you, we send you letters and so forth to remind you have to do your RMD, but you don't do anything. So what will happen is, in the first week of March of the following year, you're going to get a check, and it's going to be your RMD amount for that first year. Now, even you had until April 1st, but in reality, we can't push it. We can't. Our system doesn't allow us to push light up to March 30th of the following year. So we get that check. So it's going to get you right to your RMD for that year. You still don't do anything. You just continue to draw from your other sources of income. About the third week of December, you get another check, and it's your RMD for that second distribution year. And you can just go. You can take the story out. You can go as long as you want, up to age 100 and whatever, and you're not taking any withdrawals from the TSP. You're going to get one check a year in December of your RMD amount exactly. You don't have to do anything. So you're not in danger of getting a penalty from the IRS because you didn't take your RMDs. We're going to send it to you automatically. If you want, though, you can start your RMDs and fill out, installment payments or however you want to do it, lump sum payments. It'll all count toward your RMD amount, and we'll know. But if you're getting installment payments, let's say that you're drawing down your account based on the 4% rule, and you're adjusting for inflation as the years go by. But as you get a little bit older, you find that percentage that you have to take out according to the RMD rule starts to go up, and maybe it exceeds the amount you would take out under the 4% rule strategy. So you get to December, you've maybe got 12 installment payments already. You'll get a 13th check from the TSP, which will be whatever amount to get you right to the penny of what your RMD is for that year, if you've fallen a little bit short. So what I'm saying is that with RMDs, used to be you have to do a bunch of stuff. Now with the new rules, you don't have to do anything. You can sit back, you take out what you need, and we'll send you the difference into the year. But truth is, you're probably going to want to keep better track of that and know how much your RMD is, and do a little bit more efficient management of how you get those payments. So questions? I'm going to show you the amounts now. So here's the tables. The orange one is the one I said, this is the last 10 years of the single life table.
We have
And you
a
can see
question.
we have, yes,
We
okay.
have a question. Sorry.
That's right.
Isn't it possible that you can actually avoid tax on the RMD by having it go right into a qualified charitable distribution
Yeah.
and given to
Yeah.
a qualified charity?
Yeah.
So tax is not paid at all.
Yeah, so as long as it's, so I'm not going to, I don't want to try to venture into that because I'll make a mistake in explaining that, but yeah, basically that's it. Same thing with the death benefit. You could have it go to a charity that is, like you described, and there wouldn't be any tax on it. Yep.
I just had a comment. I really appreciate your explanation. That's very helpful to us on the RMDs because, as you're suggesting, there's so many financial advisors out there that kind of scare you as to the tax implications by not doing that. So by you saying that you can let it ride is very helpful to say that. So I really appreciate your expertise.
It won't be subject to the penalty.
Right.
Yeah.
Right, because that's a big radio and TV people that are financial advisors. My question was going to be, would you recommend going to a tax advisor or a financial advisor? Because both could have their perspective on that issue too. So what you just said was very helpful, I think. So
Okay.
thank you for that.
Thanks. Okay, good. All right, anything else? Okay, so the table you see on the left has the age to the left, and then the next column is the distribution period. So this is the factor that I'm talking about. So the way I would determine my payment under the single life table would be I take my account balance and I divide that distribution period into it, and then that's the percentage. Well, it's going to be the dollar amount, but it's also a percentage of my account that I have to take out for that year. And if I'm taking the payments monthly, I would divide that by 12. So let's go over to the uniform lifetime table. So let's say that I'm not taking any withdrawals, but I have to start taking withdrawals according to the RMD rules when I'm 70 and a half. So I would take, let's say, for example, $100,000 divided by 27.4 gives me approximately, whatever the amount is, it's going to be approximately 3.649 something percent. So I rounded up to 3.65. That's how much has to come out of my account for that year. And if it's monthly payments, I might just divide that by 12, and then I get my RMD amount for the full year. And then the next year, it's going to be based on my, actually, account balance as of December 31st of the previous year, and then I just continue to do it that way. So if you're comparing this with a 4% rule that a lot of you are familiar with means that the first year, you take your total account balance and you multiply by 4%, and that's the amount of that you can take out for that first year in retirement. So for example, if your account balance is $500,000, 4% of this is $20,000. So you take out $20,000 for the first year. You might divide it by 12 and you get $1,677 a month. For the second year, you have to add an inflation factor. So you're going to look at what the inflation factor, the CPI, was for that first year, and let's just say, for example, it's 1%. So you take 1% times 20,000, be $200. So that second year, your amount you can withdraw is $20,200, and you continue to adjust for inflation over the course of your period of retirement. And the 4% rule was built around the idea that you can make that money last for 30 years. And 4% is the maximum, and it's based on studies that this guy, William Bengen, did, where he did like 62 rolling 30-year periods, and he found that of all those rolling 30-year periods, that it was actually 4.15% was determined to be safe max. This maximum withdrawal that you can take out and still be safe that money's going to last for 30 years. So that's different than this. This is just basically sort of like the numbers you see in the right-hand column is essentially, that's the percentage of your account balance you have to take each year. So you can get, as you get older, you can get to a point where if you're doing the 4% rule, that the RMD amount may exceed the amount to take out for the 4% rule, depending on inflation. If inflation is really low, then this might exceed that. But if inflation is running 2.5–3% or something, you probably would, the 4% rule would be a larger withdrawal. But even if you have Roth money in your account, the Roth money is still subject to the RMD rules. So you may be, thinking, well, there's lots of things you can consider. As you got Roth money, you want to take the Roth money out and put it in a Roth IRA, so you don't have to take RMDs. That may be fine, but then again, you go back to the low expenses of the TSP. Given your choices of where to put the money, you may be better off even taking the RMDs of that Roth money and taking that, assuming you don't need to spend the money, put the Roth money in a savings account. You may still be better off because of the low fees of the TSP. But this is things you can probably analyze and look at in a little bit more detail. So there's a resource listed here for the fact sheet that we have. It's called Important Tax Information About Your TSP Withdrawals and Required Minimum Distributions. And it's a printed publication, but you can download it from the TSP website as well. And I'll show you in a little bit here where that is on the website. But if you click the link, it'll take you to that page. So questions, RMDs, and okay. Oh yeah.
You want the mic?
Yeah. Well, yeah. So the question is, these tables. What do these terms mean, and what's the difference?
We try.
The thing is, it's probably not a good idea for me to try to guess at what this means, because this is the IRS published these tables about 15 years ago, and this is what they named them. So even if you're married and you want to take payments based on life expectancy, the TSP has to use this table up to age 69. And uniform lifetime table, it doesn't matter your marital status, you have to use this table. And essentially these distribution periods, these are just actuarial calculations that the IRS assumes, I guess based on, for financial reasons, maybe it's not technically, correct based on all the, whatever data that's available. But they're saying that if you're age 60, you're going to need money for 25.2 years, and that's what they base this off of. So you see the numbers go down. And I suppose here, if you lived age, and so it changes over here. You lived age 70, now all of a sudden your distribution period is 27.4. We can take this all the way out, and at age 115 it becomes 1.9, and then it just stays 1.9. So if you're 115, they expect you're going to need money for 1.9 more years. So I know that doesn't answer your question, but beyond that, you'd have to talk to the IRS actuary people, because I don't know any more than that. That's probably going too far to say what I said. So this is just a screenshot from the calculator. I could probably show you, but if I try to switch over to the website, I'm probably going to lose the screen, and I'm going to have a problem getting it back. But under Planning and Tools on the website, you go to Calculators, and I'm just trying to highlight here the Retirement Income Calculator, which allows you to take, let's say I want to use $500,000 in my account for monthly payments, and I can put in my age, I want to retire and start drawing income, my expected rate of return, and I can see how long the money's going to last. But it's just going to show me level payments for the rest of my, every month for the rest of my life. And when the money runs out, it shows, okay, now at age 85, the money runs out. Now, for the retirement income calculator, it's really an extremely simplistic calculation, because if you retire at age 60, you're not going to keep your payments the same every month for 20 some odd or 30 years. It's just crazy. You're going to have to add a factor in for inflation at least. But it gives you a starting point. But what's maybe more useful in that retirement income calculator is the annuity side of it, because if, like I said, all that information, what the variables are, you can plug that in and you can see, okay, if I choose an annuity at this age, given this amount of money, my wife's age or my husband's age here, what am I going to get? If I choose a cash refund feature, what am I going to get? If I choose survivor, 50% survivor benefit, what am I going to get? So you can see, and it's worth maybe going in there, playing around with it. And I can't really, give you the full idea just by talking about it. I think you have to go in there and sort of plug numbers in, play with it, see how it works, try different things, and then it'll begin to become more clear, how you can use that. But probably what you're going to want to do is go beyond what we have on the website, and that's where you may enlist the help of a financial planner or an accountant. And then the financial advisors. Financial advisors can be financial planners that will help you. They'll take you on as a client, and they'll charge you a fee, but they're not trying to sell you any financial products. And then there's the financial planners or financial advisors who derive their income entirely from financial products that you purchase. So you just need to go going in, up front what the rules are. But of course, a lot of financial advisors, they're gonna want to sell you financial products. Yes, sir.
For some people who are fortunate enough to be, well, I'm not saying fortunate or unfortunate, let's say single, and when they retire, really, if they don't need the TSP money, the only time that money will come out of TSP is when they reach 70 and a half, right? You can just don't do anything, just let it sit.
Exactly. That's right. Right. Yeah, and then you only have to take the required minimum distributions. And then even then, you could have those go to charity. Want to do that?
I have a charity.
Oh, okay, you have a charity. All right. I had somebody, we had this discussion, this must have been 4 or 5 years ago. I remember, in fact, I was over at Andrews Air Force Base is where it happened. I remember it now. And somebody asked the question, it was around RMDs. If I don't need the money, can I have it go to the U.S. government to help pay down the debt? I never had anybody ask that question before. I'm not even quite sure that you can do that. I suppose you can. I mean, because you do your taxes and just say, yeah, here's a little bit something extra. You know, I'm not sure how that works. But there's plenty of places that'll take your money, I'm sure. All right, so we're almost toward the end here. We're going to talk about some other considerations to include spouses' rights. If you're a FERS employee or uniform services, that's self-explanatory. When you take a withdrawal and it's over $3,500, your spouse has to sign the withdrawal form. And both of your signatures have to be on there, but both your signatures have to be notarized. So there's few, if any, exceptions. And the exception that this references, if your spouse's whereabouts is unknown, you have to fill out this TSP 16 and attach the FBI report that indicates that, you know, your spouse's whereabouts is unknown, not that they just, you know, they went shopping and you don't know when they're going to be home type deal. So CSRS, if there's any CSRS in here, the rule is different. You fill out the withdrawal form. You don't need your spouse's signature, but you have to fill out your spouse's address. If it's your same address as yours, then that's easy, but it might be a different address. And what we do is we send your spouse a letter to say that your spouse took a withdrawal of money from their TSP account, and the law doesn't require that we tell them how much, so it just tells them basically they took a withdrawal. But it's sent to them 2 days prior to when we disperse the funds. This is in reference to this very important fact sheet that we have that you can download from the website. And it may be that, Phyllis, when you order materials, you may get this fact sheet as part of your order, I suppose. But it's for those of you that are like within 2, 3, 4 years of retirement, maybe, you know, beyond that, maybe it's not necessarily you read that right now, but it is mandatory reading. You've got to read that in order to understand what the tax rules are. And it's an 8-page little booklet, and on the very last page there's a chart. And in the left-hand column it shows you all the ways you can take money out of your TSP account, whether it's a lump sum payment after you retire, or it's quarterly installment payments, or it's it's final single payment, or whatever that is. It tells you if it's an eligible rollover distribution with the rules I explained earlier, or a periodic payment. And this is just the sections of that sheet, and I just want to really foot stomp this. If you're retiring within at least like 2 years, by all means, definitely, you got to read this. And don't be one of those people that makes assumptions about what the taxes are because you heard from somebody somewhere and you thought it was a certain way, and it's not, because that can lead to a big financial mistake. And you don't want to make financial mistakes without that much money. So this is I just took a few things from that chart. We already kind of went over what eligible rollover distributions are, lump sum payments, so forth, payments less than 10 years. Payments less more than 10 years, periodic payments based on life expectancy, which would include RMD payments. Those are periodic payments. And with eligible rollover distributions, there's another way to looking at that graphically. So even if you have a pro rata distribution, when that money comes out, it's an eligible rollover distribution, you can split it between transfers and distributions that go to you. So distributions that go to you are subject to the early withdrawal penalty if that's an issue. That's when they're taxed. If it's a transfer, you can transfer like money to a like account, tax character-wise, without paying taxes. But you can also take traditional money and transfer it into a Roth IRA, and of course then you don't tax on that money for that year. But this gives you a lot of flexibility in how you manage those payments. So we talked about one major exception to the early withdrawal penalty that applies to many of you, in here. If you're over 55 or you're law enforcement and you're over 50, don't worry about the penalty. That's done. That's over and done with. You never have to worry about that ever. Barring that, other ways to avoid the penalty would include you take the payments based on life expectancy. Annuity payments are not subject to early withdrawal penalty. If you get divorced, your spouse, to be ex-spouse, can take, if the court orders, they can take a portion of your TSP account, and there's no early withdrawal penalty associated with the amount that's paid to them. If it's paid as a death benefit, there's no early withdrawal penalty. It would apply to the recipient of that death benefit. There's a few other things there. Total and permanent disability, that's basically you qualify for Social Security disability income, then that would be a reason that you would be exempted from that penalty as well. Okay, death benefits. Two important things here is that if you have not done the paperwork, your payment of your TSP account will be by statutory order. So that means that if you're married, it'll go all to your spouse. If you don't have a spouse, go to your children. Don't have children, goes to your parents. Don't have parents, goes to the executive of your estate if you have one. If you don't have any of that, it would go to next of kin. So you may be happy with that, and that may work well for you, but you can designate specific beneficiaries. So here's where you can designate charities. You can designate, other than statutory order to individuals. You can designate whatever percentage you want to various individuals. So you get a lot of flexibility there, but you may find you want to designate some kind of more detailed instructions, and so therefore you can designate a trust as your beneficiary. So in that trust, you can have it set up so that it's follows what you would have put in your will. Now, if you have a will doesn't count. That's where the trust comes in. That's where you put the instructions. So this is really important. Kind of note this and be certain that whatever's in your account right now is the way you want it to be, because you never know when things can happen. And like a lot of beneficiaries, well, I should say a lot of participants who have died, unfortunately have left their account to someone that they filled out on a TSP 3 years ago and just didn't go back and change because it was, they forgot about it for some reason. So the way to check it would be to log into your account in tsp.gov, go to the left side, go all the way down to beneficiaries, and you click on that, and then it's going to show you, for your particular case, who your beneficiaries are according to how you have things set up. So in this case, it's statutory order, but if it was a person that had a TSP 3 on file, it would list their beneficiaries. And they can always go back with a TSP 3 in section 2, mark that cancellation, and it'll just revert them to statutory order. Or they can just submit a new TSP 3, and the new TSP 3 would supersede the old one.
It's also on your annual statement.
Oh, right, yeah, we added that back to your annual statement, that's right. We didn't used to have it on there. Yep, okay. So now when you die, where's your money go? If you're married and it goes to your spouse, that's your beneficiary, they will automatically have a beneficiary participant account set up, and we will transfer whatever amount that's in your account over into their name and their BPA account, and it'll be in the life cycle fund that's within 5 years of when they turn 63. They may be 63 already, I don't know. But it will be whatever life cycle fund is associated with, within 5 years of when they're 63. And then they got all the same rights as a participant owner of the account with regard to withdrawals. They can do annuities, they can do monthly payments, they can do, whatever. And they can set up a TSP3 beneficiary form and designate their beneficiaries, but they can't pass their account on to anyone and have them keep it in the TSP. So it's just a one-time deal. This beneficiary, though, they could take this TSP account and then transfer it into their own TSP account, or they can transfer it out of the TSP into their own 401k, an IRA. They can do lots of things like that. But if it's in the TSP, they might be better off because of low expenses, and they still have to have RMDs come out of it, though. The RMDs are going to be based on, they're going to begin based on the when the original account owner would have been 70.5, but the amount of the of the monthly payment is going to be based on the age of the beneficiary participant. So I'm not going to go over everything in this chart right here, but when you get the slides, maybe you can take a look at this if you find this to be of value. But two things with a BPA that give it a little bit possibly an advantage over other places you can transfer the money is, one, there's no early withdrawal penalty associated with BPA accounts. Number two, the BPA account doesn't have spouse rights attached to it. So this person could get remarried. The new spouse doesn't have rights to that BPA account money. If they transferred it into their own TSP account, well, then that would change. Now, if the beneficiary was a non-spouse, in this case, the non-spouse would have a choice. They could take a lump sum withdrawal. If it's a really large amount of money, they might decide that's not such a good idea. In that case, they could decide to have that payment just transferred directly into what's called an inherited IRA. So they would set up an inherited IRA through their own bank or credit union most of the time, or through a brokerage. And then by doing so, they wouldn't have to take withdrawals until the following year. And even then, as the years go by, they only have to take the required minimum amount. So it's like we're just talking about the RMDs out of your retirement account, but this is out of a beneficiary, inherited IRA account. Yeah.
And a good example of that could be like if for some reason your spouse and you both died at the same time, tragically, obviously, but you had kids and the kids would inherit it.
Right.
Right. I mean, that's a good example of it.
Right. Yeah. So,
so how do you set that up ahead of time? How do you?
You wouldn't have to set it up ahead of time. We've got a booklet that you can read about this on the website, but what happens is the team that does this, the office that does this, they contact the beneficiaries. They go through the whole process to determine the beneficiaries. Then they contact them, and they make sure that they understand and know all this. And that they don't just send a check and say, "Oh, here you are," but they give them time to set things up, and they explain what an inherited IRA is and how it works. So by the time they get paid them out, the beneficiaries will, they'll have time to set things up how they want it to be.
Okay.
So they'll be able to choose all that. So I didn't put the text up there, but there it is. Yep. Okay, so I am almost done. Just a couple more things. There's the website. I pointed out a couple of times that there's forums and publications that you can find more information. But if you look in the top right-hand corner, you can see we got the Facebook and Twitter little emblems there. But look to the left, you see Contact TSP, then you see Forums and Publications. And you can click on Forums and Publications, and you'll see on the left-hand side, you got all the topics. And you can drop down to whatever topic, click on that. Then you'll see the forums associated with that and the publications listed to the right. So the slide we have here is just a list of the things you can do if you log into your account. You can access your statements, and you can do interfund transfers. And now we have the ability to do two-factor authentication when you log into your account, so that your account's a little bit more secure. We just started that a couple of weeks ago. So if you haven't logged in recently, you know when you go back and you log in, you're going to have to provide like a text number or an email address so that you can verify, the next time you log in. So it's a lot better than it used to be. More secure, I think, and easier to access and change your password if you need to. And we have other ways to interact with the TSP. We have the TSP official Facebook website. We have the official TSP Twitter account. We have the TSP Thrift Line. This is my personal favorite. I'm not big on getting information from Twitter, but I'm big on calling the Thrift Line and talking to a real live person and asking them questions, and they can open up my account and look at it and tell me. specific answers to my questions. The secure message centers, if you log in, you can, instead of calling the thrift line, basically you can type a message and send it through the website, through the secure message center, and then you go back and log in. Usually within 24 hours you'll get a response, and you can see what your response is there to your questions. So this slide just shows you some graphic images of some of the publications you can download. This is the withdrawal booklet that's going to change with the new withdrawal options, but it still has some accurate information, especially as I was mentioning with regard to annuities. The summary booklet is the overall publication. Way over in the corner, I know you can't see it, but that's what the fact sheet looks like. The one I was talking about that has important tax information about withdrawing money from your TSP account. I said it's mandatory reading. So, all right. Well, yes, sir.
Thank you very much.
You're welcome.
Very, very useful for taking the time, all your preparation, and thanks to HR for all their good work and putting this stuff together. Very, very useful. Suggestion. Some years ago on the quarterly statements, you guys did something called the personal rate of return. Great idea. It covers the last 12 months. Yes, exactly right. My suggestion, not your department probably, but take it back to TSP, put that in there for the life of a person's account, particularly for younger employees, so they can really see how much has my account grown over the life of my account, not just the last 12 months. Us old timers that are near the end, it's not going to matter that much because we kind of know, but those young people aren't paying attention. That would be a good thing for them to have out there, not just for the last 12 months, but for the life of their account. I don't think there's a way to do that. I've called the thrift line and asked that, and I don't think there is a way to do that. Because I was kind of curious, and basically you have to go through your own paperwork from way back when, and of course
Yeah,
early
it would
on in
be too.
TSP you had to do percentage, so you didn't really know what it was.
Yeah.
So anyhow, it would just be a way to see, okay, this is really how much it's grown versus something in private as to
Yeah.
how my account has grown. Just a suggestion, just a
Right.
small little suggestion, no big deal.
Yep. Yeah, I know what you're saying. I'm just sort of thinking how to do that. It is a complicated computation to the max, because
Yeah.
even the annual one, it's so you can take a fund and you can just take the beginning and ending share prices
Right.
and you can calculate
Right.
the return. But for our accounts, you've got money going in,
Right.
then you move it around. You
Right.
sell it and you buy shares, and this is constant. Then you take a withdrawal, then you have countries. So they're in different periods. So I worked in the Office of Investments last year, so I was involved. So I'd done a lot of the math, but I used to work in participant correspondence, and people would write in with questions similar to that, like they want to know numbers and calculations and percentages, and I spent a long time building spreadsheets to calculate things, and so if anyone here is into math, there's something called the modified Dietz method that you use with cash flows, and it is a nightmare. So I'll take it back and I'll talk to the communications and see if they can do it. But I don't want to have to be the one doing the calculations. I'll tell you that. It is the calculation nightmare with that.
I just see a lot of young people not really realizing the importance of getting in early. And that's my issue.
Yeah, right, yeah. It would be simple if they put their money in and we could just measure just one fund, but then we got the cash flows. But
That's
but
all right. That's all right.
we try to we try to motivate. We go to like with the military, we get the calculator out and we say, if you do this, and assuming this rate of return, it'll look like this. But I'll go back and I'll ask the question with our communications director and see what he says. I mean, he might, and we're got a new website coming. There's a new design to the new website that's going to be coming here in a couple of months, and I don't even know, maybe they've added something like that. I don't even know what they're doing with that. There might be something more that allows you that, because there's other plans out there where I think you can do that, can't you?
That's right. Yes.
They got it built in somehow
Yes.
that you can do that kind of a calculation. So I'll go back and I'll mention it to him. Thanks. All right, yes, sir.
And I may have missed this, so I walked in a little bit late, but if you retired on a certain date, how soon after you retire are you able to receive the first payment from the TSP?
So official thing is we say 5 to 10 business days,
Huh.
but I've heard that they can process it faster than that. If the form is received, there's no errors, everything is clean and good, they can process it quicker than that.
Okay. And maybe before you actually retire, you're able to provide them with the bank account that you want the money to go into, so it's all set up.
We wouldn't be able to do anything before you retire, because if you send anything
so it
into the
has to be
TSP,
after. Okay.
we're going to see that you're not separated, and it's just we'll just return it back to you and say we
Yeah.
can't process it.
All right, very good.
All right. Well. All right, well, thanks everybody for coming. I wish you all the best. There's a survey at the end of the thing. Thanks, appreciate it. So if you want to do the survey, there's a link, and if you get the slides electronically, it'll be easy to click on that. Thank you.